So because Wall Street didn't actually publish consensus estimates ahead of this print, we do not have a traditional beat or miss to report. But for the second quarter of 2026, Tucows posted consolidated revenue of just over $100.5 million.
Right, which is up 2.1% year over year.
Yeah, up 2.1% and up 4% sequentially. But, the bottom line immediately tells a very different story. The GAAP basic loss per share came in at $1.84. I mean, that is a 30.5% wider loss compared to the $1.41 they lost in the same quarter of 2025.
And their adjusted basic loss was $1.57, right?
Exactly. So looking ahead, management is officially dubbing 2026 a transition year. They are guiding toward portfolio simplification, a potential divestiture of their Ting fiber business, and the resolution of legacy mobile obligations by the third quarter.
And the stock reaction to all that data was it was highly volatile.
Oh, incredibly. TCX closed the regular session at $14.12, spiked over 11% in after hours, trading up to 15.64 on those initial headlines, but then completely retraced during the next regular session to close down fractionally at $14.07. So, okay, let's unpack this.
Okay.
Why would the market pop 11% on initial headlines, only to sober up and erase it all by the next day's close?
Well, that kind of market whiplash is exactly why you have to look past a consolidated top-line revenue number. An algorithm scanning a press release at 4:05 p.m. just sees top-line growth and a specific segment hitting profitability.
Right, and it triggers an immediate buy order.
Exactly. But when human analysts and institutional investors actually read the 10Q the next morning, they see the structural mechanics driving that valuation, and they start unwinding those positions. That 2.1% consolidated revenue growth is hiding vastly different underlying realities across their three main operating segments.
Let's break those segments apart then, starting with the obvious catalyst for that after-hours pop, which is Ting Internet.
Right, their fiber-to-the-home business.
Yeah, and purely from an operational standpoint, they delivered a landmark turnaround this quarter. Revenue for Ting surged nearly 32% to $21.6 million. They added 8,500 net subscribers, bringing the total base up to 60,500.
But there is a really crucial detail buried in that revenue jump.
You mean the construction revenue?
Yes. They recognized just over $4.1 million in construction services revenue related to a fiber deployment for Laguna Woods Village, which is this massive homeowners association in California.
And why is that specific $4 million so important for the listener to catch?
Because building fiber networks is notoriously capital intensive. Usually, a company spends millions digging up streets and laying cable, and then they have to wait years to recoup that upfront capital expense through, like, $80 monthly subscription fees.
Right, the payback period is usually brutal.
Exactly.
Yeah.
But in this case, by recognizing upfront construction revenue for a large-scale deployment, they're offsetting those heavy capital expenditures immediately. I mean, they had zero construction revenue in that segment a year ago.
Oh, wow.
So that $4.1 million influx directly altered their margin profile for the quarter.
Which pushed them over a massive profitability hurdle. Ting reached a positive segment adjusted EBITDA of $1.52 million.
A huge operational swing.
Massive.
Right.
When you compare that to the $3.7 million EBITDA loss they reported in the exact same quarter last year, you're looking at a more than $5 million swing. It is their first positive EBITDA quarter for Ting since they began reporting it as a separate segment.
Which completely validates the unit economics of their fiber model. It proves the model works at scale. But obviously, Tucows is a sum-of-the-parts business, right? And the legacy engine of the company is Tucows Domains.
Right.
On paper, that segment looks like it's contracting. Revenue fell almost 4% down to roughly $65 million. The total domains under management shrank from 24 million a year ago down to 21.3 million.
Because of that large reseller moving in-house.
Yeah, management specifically noted it was due to a large wholesale reseller deciding to move their domain portfolio.
So, if you are looking at the stock and seeing their legacy business lose millions of domains, your initial reaction might be concern. But when you look at the margin mechanics, the revenue drop essentially didn't matter.
Not at all.
Because the volume they lost was incredibly low-margin bulk wholesale business. So while revenue dropped, the gross profit for the domain segment remained completely flat at $19.26 million.
And shedding that low-margin volume actually highlights the strength of their product mix. Within that same segment, their higher-margin value-added services, which includes products like hosted email and internet security, that actually grew 9% to $6.3 million.
That's great.
Yeah, Tucows Domains is acting exactly as a mature tech business should. It's serving as a stable, highly efficient cash flow engine. They maintain their actual gross profit dollars despite a top-line contraction.
Which means they are generating the same amount of usable cash from a smaller, more profitable base of customers. So Domains is providing steady cash, and Ting is finally turning a profit after years of heavy capital expenditure. Logically, you would think that should translate to a healthier bottom line. But instead, that brings us to the capital drain, which is way below services.
Yeah, they're a cloud-based software platform for telecom providers.
Revenue here fell 7.1% to just under 11.8 million. But the real issue is the profitability. Segment adjusted EBITDA plummeted over 47%, down to 2.83 million.
Which management attributes to deliberate, ongoing sales and marketing investments.
Right.
They are spending heavily to try and convert their enterprise pipeline into recurring software bookings.
But I have to challenge the timing of that spend. We are looking at a software segment with shrinking revenues in a macro environment where capital is incredibly expensive.
Well, that capital allocation strategy is the central tension of the Wavelo segment. Wavelo's customer base is currently highly concentrated. Dish Network is their primary mobile client, and their own Ting business is their primary internet client.
So they need to diversify.
Exactly. If you want to scale a SaaS business, you have to diversify away from that kind of concentration, which means investing heavily in a go-to-market strategy to land new large-scale enterprise contracts.
Sure, but telecom enterprise sales cycles are agonizingly slow. You are dealing with requests for proposals, massive security audits, complex legacy system migrations. I mean, that cycle can easily take 12 to 18 months before a single dollar of new revenue is booked.
It's true.
So is burning cash on marketing in this specific environment actually going to yield conversions? Or is management just throwing good money after bad while waiting for a pipeline that might never materialize?
And look, the market is clearly sharing that exact skepticism. It goes back to the broader financial reality of the company. The enterprise sales cycle is long, and Tucows just does not have the luxury of time,
Right.
which becomes glaringly obvious when we look below the operating line.
Yeah, here is where it gets really interesting for anyone diving into this print. If Ting swung to a profit and Domains maintained its gross profit dollars, how did the consolidated net loss for the entire company widen by over 30% to nearly 20.5 million?
Because the answer lies entirely below the operating line. The operational progress in those segments is being completely swallowed by the balance sheet.
The balance sheet right now is a structural anchor. Tucows is operating with a heavily leveraged capital structure. Total liabilities sit at $928.5 million.
Yeah, and the long-term debt has two primary components. They have a syndicated revolving credit facility with a balance of $190.4 million, and they have long-dated securitized fiber notes at the Ting level totaling $301.5 million.
Those securitized fiber notes are a fascinating financial instrument. Essentially, the company took the physical fiber assets they built in the ground, along with the predictable future subscription revenues from those neighborhoods, and used them as collateral to issue bonds.
It is a smart way to raise capital for infrastructure, sure, but it still carries heavy fixed debt service costs.
Right.
And when you combine that with the floating rate nature of the revolving credit facility, the current high interest rate environment is just punishing their cash flow. Net interest expense hit $14.45 million just for this second quarter.
Let's actually do the math on that to show the listener just how severe this is. The net interest expense was $14.45 million. But the consolidated adjusted EBITDA for the entire company, meaning the core cash profitability of all their operations combined before paying that interest, was only $12.30 million.
That doesn't cover it.
Not even close. If we calculate the interest coverage ratio by dividing that EBITDA by the interest expense, we get approximately 0.85.
And an interest coverage ratio of 0.85 is the textbook definition of a structural deficit. It means that for every dollar of interest they owe their lenders, their actual business operations only generated 85 cents.
Their core operations literally cannot satisfy their floating rate debt service costs.
No. They are forced to rely on existing cash reserves, draw down further on their revolver, and optimize working capital just to pay the interest.
Think of it like buying a large apartment building with a variable rate mortgage. You renovate the units, you get great tenants, and your rental income actually goes up, just like Ting's revenue grew 31%.
Right, great operational execution.
Exactly. But because interest rates spiked, your monthly mortgage payment to the bank jumped so high that the rental income doesn't even cover the interest anymore. The building is operationally successful, but financially underwater.
That's a perfect analogy. And management did take two major survival steps this quarter to keep the property, so to speak. First, they retired the Ting Fiber Series A preferred units.
Okay, which eliminated a $150 million compounding equity burden off the board.
Yes. And second, they successfully extended the maturity on their syndicated revolver, pushing the bulk of it from September 2027 out to July 2029.
So corporate triage. They successfully stopped the immediate bleeding of a default or a massive principal repayment.
They did, but the underlying disease remains. The floating interest rate is still eating over 115% of their operating profit. Because the debt service is consuming all the cash, structural deleveraging is no longer optional for Tucows. It is a mandate.
Right, they cannot simply operate their way out of this deficit with 2% consolidated top-line growth.
No, they need a massive lump sum of capital to pay down that principal. And this leads directly to management's stated strategic review of divesting Ting.
Which brings up a massive strategic contradiction, what we could call the Ting divestiture paradox. Management wants to shift to a capital-light model by divesting Ting. And hitting positive EBITDA proves the fiber model and maximizes Ting's sale valuation, right?
Yes, it proves to private equity buyers or larger telecom acquirers that the unit economics are viable.
But here is the catch. Ting is the only engine driving top-line growth. It's up nearly 32%. Selling it would clean up the balance sheet, sure,
But it fundamentally hollows out the future of the company. If management successfully divests Ting, you instantly transform Tucows into a highly mature, slow-growth utility business. You are left with a domain registry business that is flat and contracting slightly, and Wavelo, which is actively burning cash and struggling to convert its pipeline.
and that reality is heavily reflected in the analyst perspectives right now. Zacks Investment Research downgraded TCX to underperform back in June due to this exact debt burden and rising operating costs.
Yeah, the broader market is clearly discounting a recovery, considering the stock trades around $14 and is down over 80% from its historic peaks.
But in the spirit of examining all angles, the sources do note a single outlier sell-side analyst who maintains a $150 buy target on the stock.
Which is an incredible premium.
Right. Getting a stock from 14 to 150 requires a monumental shift in enterprise value. What assumptions are baked into an aggressive contrarian model like that?
Well, it requires a flawless, theoretical best-case execution on multiple fronts. First, it assumes that Tucows secures a massive premium valuation at Ting divestiture, meaning a buyer pays top dollar for the fiber assets despite the high interest rate environment.
Okay.
And second, it assumes that Wavelo successfully executes its standalone monetization, meaning all that marketing spend we debated earlier actually works. Wavelo lands huge enterprise telecom contracts and transitions into a high-margin SaaS business. It's a sum-of-the-parts valuation that assumes every single part reaches its maximum potential simultaneously.
So if you are a retail investor listening to this deep dive today, how should you classify this stock? Is Tucows still a technology growth story waiting to break out? Or has it essentially devolved into a distressed asset play where the only real upside depends entirely on finding a buyer for Ting?
If we look purely at the financial mechanics, it behaves much more like a distressed asset play right now. When your interest coverage ratio is below 1.0, growth takes a backseat to survival. Management deserves credit for extending their runway to 2029, and Ting's operational turnaround proves they built a valuable infrastructure asset. But until that debt burden is resolved, the equity value is severely capped by the cost of capital. A traditional growth stock implies that operational success flows down to the shareholders.
But right now, Ting's operational success is flowing directly to the syndicated bank lenders and the bondholders.
Exactly.
So to quickly summarize the quarter, a great quarter for Ting's operations, finally crossing into positive EBITDA and showing strong 31% revenue growth. Domains held its gross profit steady despite losing a major reseller. But all of that operational heavy lifting was completely overshadowed by a brutal capital structure, a $14.45 million interest expense bill, and widening net losses.
Right. And management has officially labeled this a transition year, so their ability to execute a divestiture of Ting will dictate the future of the company.
But there is one hidden risk in this transition strategy that investors need to mull over before we wrap up. We mentioned earlier that Ting is currently Wavelo's primary internet client.
Yeah. Wavelo software runs Ting's billing, provisioning, and customer management.
So if management successfully divests Ting to a third party, say a larger telecom aggregator or an infrastructure fund, what happens to Wavelo?
That is the big question. The new owner of Ting is going to have their own legacy software systems.
Right. They might decide to migrate Ting's operations off of Wavelo and onto their own proprietary tech stack to realize cost synergies.
Exactly. By selling their best, fastest-growing asset to save the balance sheet, Tucows might inadvertently pull the rug out from under their remaining software business. They could cure the debt disease, but cause massive collateral damage to Wavelo in the process.
Wow. It is the ultimate sum of the parts valuation problem, but the parts are deeply intertwined. Separating the fiber network from the software platform without destroying value is going to be the ultimate test for this management team over the next 12 to 18 months.
It really highlights just how fragile a corporate turnaround can be when the balance sheet is dictating the strategy rather than the operations.
Absolutely. Well, if you want to cut through the noise and get straight to the structural mechanics driving the market, make sure you follow the show for daily, no-nonsense earnings coverage. We will see you next time.